right, good afternoon. For those who don't know me, my name is Rannestad. I'm a commodity analyst at CPM Group. I focus primarily on the precious metals and more specifically the platinum group metals and silver. So as Jeff mentioned, we're gearing up to launch our 27th volume of the Platinum Group Metals Yearbook. That will be released on the 24th of June at the IPMI conference. It's the first time that we're launching it at the IPMI conference. We're very excited. And it'll be launched at 11:30 a.m. New York time and will be broadcast live online. So details about the event will be delivered via email in the next few weeks. We're still working on the content of the yearbook, so a lot of the slides that I'll be showing you today are preliminary in nature, but I will give you some insights into some of our initial findings today. Two things to look forward to in this year's yearbook that will separate it from previous years is more disaggregated information about hard disk drive demand for platinum, as well as some new disaggregated data on secondary supply. So the platinum market was in a deficit of over 400,000 ounces last year. This was different from previous years when we were in surplus. For those who are familiar with our information on the platinum group metals and our data, you'll notice that the balance looks somewhat different than in our previous edition. That is because as we've been developing and disaggregating our secondary supply statistics, we are adjusting some of the numbers from previous years. I'm not going to get too into that in this presentation today, but there'll be a lot more detail about those revisions in this year's yearbook. Going forward, this year we expect the platinum market to remain in a very large deficit. What we're seeing mostly that is driving that deficit is weakness in investor demand for platinum, as well as reductions in mining capacity and reductions in secondary supply. There are a lot of factors in the platinum group metals markets that we believe poise these metals for future price increases. In the medium term, we've seen a lot of price weakness, mostly driven for platinum by weak investor sentiment toward the metal and the market, as well as weak European demand for the metal, particularly for the use in auto catalysts. Palladium, somewhat similar to platinum, but in contrast, remains in surplus, but that surplus diminished very sharply in 2012 due to the capacity reductions in South Africa. And I'll speak more in detail about those capacity changes in 2012. So last year we saw a 5.6% reduction in PGM supply. This was almost entirely driven by lower South African mine supply. For platinum, mine supply in South Africa declined by about 12%, for palladium about 9%. This was driven by the three major strikes that occurred in South Africa last year, all of which lasted about 6 weeks. It reduced capacity for mining of platinum group metals by about 600 to 650,000 ounces. And then the additional ounces lost were attributed to safety stoppages and lower ore grades and a host of other factors. We do expect to continue to see weakness in supply growth. While much of this is driven by a host of external factors, we're also seeing reductions because of the rising cost of mining platinum group metals. Now, over the past 3 decades, we've seen double-digit annual increases in the cost of mining platinum group metals, so particularly in South Africa, as I show here, but that trend is not really expected to change anytime soon. We still expect in the medium term double-digit increases in the cost of mining platinum group metals, most of which are driven by rising and high labor costs. rising electricity costs, declining ore grades, and a host of other factors, disruptions due to geological anomalies, the list goes on. Last year, we saw about a 15 to 25% increase in cash costs, mostly due to the reduction of mining capacity. So the per unit cost would be much higher when there's lower output. Going forward, the picture for mine supply growth is pretty negative. The makeup of platinum group metals mine production is very highly concentrated, most of it coming from South Africa, particularly for platinum and rhodium, which has the highest exposure to South African mine production. Palladium has a little bit less exposure because a lot of palladium is produced in Russia. Going forward, the capacity growth in mine production of platinum group metals is pretty highly concentrated, with about 87% of it coming from South Africa, which leaves a lot of room for the risk of either these properties not being developed because of weak price environment, changes in cost structure, and a host of other issues. And then we only have a handful of projects outside of South Africa, all of which do not have the grade quality relative to South Africa. So there's a lot of risk going forward due to the high concentration of platinum group metals supply. Now, this chart shows the capacity expansions or capacity additions that we expect in the PGM space from mining going forward through 2016. As you can see, in 2012, there's a huge reduction in the existing capacity base due to the loss of mining output from the 3 major strikes that occurred last year. Much of that will be recovered this year, although there were 2 mine closures that reduced overall existing capacity. And then we do expect further declines in 2014. That takes into account the Anglo reductions. Between 2011 and 2016, we're expecting about a 0.5% compounded annual growth rate for capacity of PGM mining. I use 2011 as a base because 2012 is a little bit misleading due to the huge reduction in existing capacity. But if we look at that, it would only be about a 1.8% expansion, which still is pretty low. So this is a snapshot of some new work that we will be featuring in the Platinum Group Metals Yearbook this year. What these charts show is the available feedstock of PGMs from spent auto catalysts that are salvaged from vehicles each year. In platinum, what we're seeing is a huge reduction over the past few years of the available feedstock to the recycling auto catalyst industry. And that's mostly been driven by the fact that a lot of the vehicles that are coming into the salvage market today contain a lot less platinum because of the switch that occurred in the early 2000s from platinum to palladium in the gasoline market, particularly in the US. So we are expecting some reductions in secondary supply going forward due to this reduction in feedstock available to the recycling industry. That said, over the past year and a half, longer, we've seen weak prices, which has reduced the amount of supply that's actually getting into the market. So perhaps in 2013, 2014, we could see some increases in what is actually being fed into the recycling circuit with price increases. For palladium, the picture's a little bit different. We're starting to see that the palladium coming out of auto catalysts from salvaged vehicles is kind of reaching a plateau point. Now, I talked a lot about the supply constraints that we're seeing in the market. We see that as a very bullish factor. Supply constraints are a bit more bullish for platinum than palladium because of platinum's higher concentration on the supply side of South Africa. But for this chart demonstrates what we see is structurally strong growth in auto demand, which is positive for the platinum group metals because of its use in the auto catalysts. This is a bit more positive for palladium in the medium to long term. And what we're seeing is that we're auto sales globally are increasing, reaching new record high levels. This presents a structurally strong case for demand growth going forward of the platinum group metals, particularly palladium. Okay, so I talked about some of the medium-term factors that I see as being positive for the platinum group metals. Now I'm going to switch gears and focus on platinum. Okay. So platinum prices have been largely range-bound since the fourth quarter of 2011. We are seeing this year a stronger support level at 1,400 relative to 2012, where the support level was really closer to 1,350. This is mostly, I think, being driven by the reduction in mine supply capacity, which is providing greater support and presenting $1,400 as a better opportunity, buying opportunity, a bargain hunting entry point relative to the 1,350 that we saw last year. Most of the weakness that has resulted in prices being range-bound has been due to weakness in the European auto market. Europe is the largest user of platinum in the auto industry, and therefore investors have really been looking at that weakness as a reason to either not participate in the platinum market or to reduce their amount of purchases. And that leads to my second factor, which is investor demand is pretty weak right now, and it hasn't picked up yet. So referring to these two weaknesses that I identified, we are pretty moderately bullish on platinum in the medium term. Over the next 8 quarters, we expect platinum prices to remain somewhat range-bound with stronger support on the downside, but we don't expect too much of a price increase over the next 2 years. That said, we do expect a little bit of strengthening toward the upside. This chart shows Etf demand trends on an annual basis. This year, we just recently reached a decline in platinum group metal or platinum demand from ETFs. So platinum holdings in the ETF space are down about 30,000 ounces this year through the middle of May. This would be the first annual decline so far since the introduction of the ETFs physically backed by platinum. So this reiterates our view that investor demand is quite weak, particularly in the platinum market. Okay. Okay, so supply we expect will improve a bit modestly this year. Last year, we saw a 12% decline in platinum output from South Africa, and secondary supply was down about 8%. Overall, 2012, we saw supply down about 10%. And this is actually still a preliminary estimate. In 2013, we expect a bit of an improvement, about 2.5%. This does factor in the Anglo Platinum capacity reductions. So as I had said, fabrication demand for platinum has been somewhat weak. However, we are expecting that in 2012, there's about a 0.7% increase in fabrication demand. Much of this was driven by strong growth in the Japanese market, healthy growth in the North American market, and growth in the jewelry market of about 1.5%. European demand declined about 14% last year, and we do expect a further decrease in European demand this year. However, we expect it to be a little bit more modest, as we could see a turnaround in that auto market in the latter half of this year. In 2013, we expect about a 1.8% increase in fabrication demand, which would be a very good improvement from the 0.7% increase seen last year. Okay, now I'll switch it to palladium. Similar to platinum, we're seeing stronger support for palladium at higher price levels than in 2012. This year, we're seeing stronger support at the 1650 level so far, and this is up from about $550 in 2012. And we believe that palladium prices will continue to draw strength from growing fabrication demand and somewhat stronger investment demand for palladium versus platinum. So as I said before, we do expect stronger demand growth for palladium, which will translate to stronger prices going forward. Over the next 8 quarters, we're a little bit more bullish on the price of palladium relative to platinum because we're seeing very strong growth in auto markets that are that more intensely use palladium, such as the US and China, which are also the largest gasoline markets. Okay. Investment demand for palladium is a bit stronger this year relative to platinum. We are seeing still positive growth in palladium ETF holdings, which we expect is because of the somewhat healthier demand profile of palladium versus platinum. So I had said before that platinum's more highly concentrated supply profile provided a lot of positive near-term support to the price of platinum, as well as presented a very positive view for the long term. Palladium has these same supply constraints. However, its exposure to Russia, about 40% of mine supply for palladium comes from Russia, which means that it is less highly exposed to South Africa than the case for platinum, which platinum's exposure to South Africa is about 60–70%, whereas palladium, it's only 40%. So that said, last year we saw about a 4.5 decrease in palladium supply, much lower decrease than for platinum. Going forward in 2013, we expect about a 5% increase in supply. Last year, the same factors that I alluded to about South Africa translated to about a 9% decline in South African mine production of palladium. Secondary supply also was lower, down about 5% due to lower prices, and Russian supply was down about 3%. Similar to platinum, we do expect somewhat of a rebound for South African supply this year, but very modest. So total fabrication demand in 2012 stood at about 8.6 million ounces, which was a 5.6% increase. A lot of this was driven by very healthy auto demand, particularly from North America and Japan, similar to platinum. We saw about a 12.5% increase in North America and about a 22% increase in Japan. A lot of that was pent-up demand and relative to a lower base level in the previous year. And electronics demand increased as well by about 2.2% last year. In 2013, we do expect strong growth to continue at about a 5.1% rate. We do expect a little bit of a slowdown of growth in North America as well as Japan. Now, the two largest gasoline auto markets are the US and China, both of which sales last year were pretty healthy. For US, it was a bit a surprise on the upside. For China, it was a slowdown, but it was still positive growth, which translates to positive growth in demand for palladium. The US auto sales in the last data point we have is for April, rose by about 8.5% in April. That was a bit disappointing to the market, but still very, very positive. We expect the US market to continue to expand at a healthy rate this year. And for China, it was actually quite surprising. There was about a 13% increase in auto sales in that market last month. And the commercial vehicle sales market in China actually rose quite surprisingly strongly at a 15% rate, which is good because last year there was actually a decline in commercial vehicle sales in the Chinese market. And now that we're seeing some more positive growth, that could actually be more positive for platinum, but still positive for all the PGMs overall. Okay, so that concludes my brief outlook on the platinum group metals. Just as a reminder, our final conclusions of our book will be released on the 24th of June. So keep an eye out for that, and we look forward to any positive or negative feedback that you may have about the new data that we'll be presenting. And I'll open it up for questions now. Yeah, what I'm seeing, and from what I've spoken with people in the industry, is that there has been some modest thrifting of the PGMs in auto catalysts that's reducing the value content of PGMs in auto catalysts in recent years. It's been very modest. We know that in the diesel market, that palladium was introduced into those auto catalysts recently in Europe. There is still some scope for thrifting going forward, adding more palladium, less platinum in the diesel market over the next 2 to 3 years. So some of that actually does factor into some of my conclusions for secondary supply, which in the long term, we could see some really interesting developments on that front. Yes? Well, platinum is a bit more efficient, but you are right. In the diesel or in the gasoline market, virtually most manufacturers use only palladium nowadays, although there's like a handful that will still use just platinum for whatever reason, depending on the engineering of their vehicle. There is concern that palladium demand could become much stronger in the near term, which would push prices higher and change the ratio relationship. If that were to occur and become a more longer-term development, then you could see more movements back toward platinum. But so far, we're not really seeing that that development could emerge in the medium term. So. Yeah, of course. Yes. You mean on a per unit basis? Yeah, the average value in a gasoline vehicle, a passenger car, is estimated to be about $50. So it'll be any combination. There's always rhodium in these auto catalysts, and then it would be a combination of platinum, palladium. So about on average, yeah. Yes?
So can you explain a little more about the differences between the U.S. and European market for autos and how that impacts and why Europe couldn't actually go the same way as the U.S.
Yep.
That would reduce
Yep. So the majority of passenger vehicles produced and sold in the U.S. is gasoline powered, and about 50% of the passenger vehicles produced in Europe are diesel powered. So it's a different composition, and the reason for that is there's some tax incentives to purchase a diesel powered vehicle. That's just as simple as that. So the reason that changes the makeup of platinum and palladium usage because diesel vehicles contain a lot more sulfur. They use more platinum, and most of it, there's several reasons why platinum is used in a diesel vehicle, but the one in particular is the sulfur content is higher in diesel. So.
And in China right now, and China looking to the future, we're expecting a higher use of the catalytic converters because of the pollution problem.
Yeah, so China has the strongest growth profile for PGM usage. It will hinge on regulatory developments when the Chinese government decides to introduce and enforce more stringent emission standards. The standards today are really low on the average basis. They're higher in major cities, but very low nationally. So while there's still a lot of positive growth, the usage is much lower than in the most advanced nations in terms of emission standards, which is Japan, the United States, and Europe.
Okay. You have the prices. Do you have estimates of average cost of production and average spread on volume and platinum?
Yeah, so I only showed a one chart on mining costs, and it was only for South Africa. We do have cost estimates on a global basis. This one is just a cash cost figure. We do calculate some all-in costs for PGMs as well, but here. Okay, yeah, so the cost of producing PGMs has been increasing at a double-digit pace. It's tripled since 2002, and it's been increasing at a double-digit pace on average for about 30 years in South Africa.
Right, but you said you have an all-in cost. What do you have an idea of what the all-in cost average is?
On the top of my head, I don't have the figure, in but you can email me and we could talk further. Okay, next question.
Excuse me, is the ratio of gold to silver like a pattern, usually it's consistent? Is there a ratio of platinum to gold or palladium to gold which is consistent?
I mean, you could create a price ratio for anything. I haven't really looked at it recently, so I don't really have a very insightful response for that. But we do have it, and we do feature it in the book, I believe, for platinum, palladium, platinum, gold. Yeah. Yes?
What's the breakdown of diesel versus gasoline cars in China and also India?
I don't recall the exact breakdown, unfortunately. Do you? For China, the diesel auto sales very, very low. It's really mostly just in the commercial vehicle market, but I would say 90-95% is. Yeah. Yes.
Maybe recall what you said incorrectly, but I thought I heard you say that you anticipate palladium demand in the United States and China to decline in the near term.
No. We expect to increase. Yeah, the percentage increase for.
Excuse me, I think what you said was fabricated.
Yeah, we expect the growth to slow in 2013 modestly from last year.
I mean, I would have thought that all the sales are actually improvement more robust here as well as in China.
Yeah. So, okay, let me correct myself further. For the U.S. market, we expect a bit more of a more modest increase in demand, but for China, we do expect a stronger increase. So I have to wrap up the questions, and we're going to move on to the next presentation. Thank you.